Hi, my name is Bonnie. I'm a manager here at Northwest CPA Group. Just wanted to do a small business tax update. Some of this it hits both individual and small businesses. Any questions, feel free to type them in the Q&A and I will help out as I can. All right. Yeah. Okay. Justine, can you nod your head if you can see my, okay, perfect. Okay, so one of the big new things is the Washington long-term care payroll tax, and that goes into effect January 1st, 2022. So in another 4 months, I guess, if I do math right. Um, the tax is 0.58% on all employee income, which is comprised of salary, hourly wages, bonuses, PTO, severance pay, stock options. So on someone who makes $75,000 a year, that comes out to $435 a year or $36.25 a month. And that is relevant due to the opt-out option, which I'll cover shortly. But there's many different factors for why you may or may not want to opt out of this program. But certainly what you make and what your income is on an annual basis is one of them. There is no guarantee that this won't increase in the future. In fact, I would say that it's more than likely that it would. I think that they're going to find that many people are opting out, and therefore, in order to provide the benefits, they need to increase the tax. That's just my personal opinion. I could be totally wrong, but just the caveat that it could increase in the future. There's no cap on the tax. So if you make $1 million on your W-2, you're going to pay 0.58% on that $1 million. Employees, for the most part, no one is exempt. If you own your own business and you've incorporated as either a C Corp or an S Corp, and therefore you receive a W-2, you are going to be subject to this tax. It is sort of similar to the Washington Paid Family Medical Leave Act that was enacted 2 years ago, I believe it was. There are some people that opt out of that own their own small business. This long-term care payroll tax is not going to be like that. Benefit eligibility. So, and this is, I find a big drawback to the program. You have to pay into the program for 3 of the past 6 years from the date of your benefits application, or a total of 10 years with at least 5 of those years paid without interruption, and you have to work at least 500 hours during each of your applicable years. So for example, someone who's going to retire in 2 years would be paying the tax, but receive no benefits later on in life if they ever needed them. Someone, and I'll cover this more too, but someone who moves out of the state can't receive the benefits in, we have a lot of snowbirds. Arizona, you move to Arizona, you live there, you retire to be close to your family. You won't be able to receive the benefits, even though you had paid into the Washington program. So the plan benefits, this is what you get for what you're paying in. You receive up to $100 a day with a maximum lifetime benefit of $36,500, meaning 1 year of care. I don't know too many places where you're getting long-term care that are only $100 a day for a maximum of $36,500 a year. So I would say that benefits are relatively minimal. Covered costs include nursing facilities, assisted care, adult family care homes, home health, like visiting angels, wheelchairs, canes, that sort of medical equipment that one might need, transportation, caregiver support, and memory care. In order to get the benefits, you have to apply to the state and show, there's a list of 10 items. You have to show 5 of the items that you need help for. There's more specifics than that, but just overall, that's the plan, that's the benefits. opt out. Many people are wanting to opt out, but the time is running down. I think that many people, if you're under the age of 40, it's hard to find a policy at this point. It can be a private insurance policy, so you as an individual can talk to your insurer and see if they can offer a plan or recommend someone to offer a plan, or it can be employer sponsored. So as a business owner, you can offer a plan to all of your employees. You don't need to necessarily pay for it, but you can be the sponsor and your employees pay for it through you. Benefits must be equal to or better than the state program. So it's not a huge bar necessarily to meet the minimum, but that's what you need in order to opt out. It must be in place by November 1st, 2021. So you really only have a couple of months to get that done and in place. And then you need to apply to the Employment Security Department between October 1st, 2021 and December 31st, 2022. ESD, I imagine that they're going to be inundated with these applications. So I suspect that many people are going to apply for the opt-out beginning in October. And total conjecture, but I would believe that they're not going to get through all of them by November 1st, 2021. And the tax, I don't believe they're going to be able to get through them all in November, December, and the tax begins in January. They'll still be processing applications until the end of 2022, I suspect. And you can't, as an employer, you need to be remitting the tax to the state beginning January 1st on a quarterly basis. So if the ESD approves the application, the employee must submit written notification to the employer, and the employer is required to retain the notice in its files. Once exempted, the opt-out is permanent, and the employee cannot opt back in at any point. The tricky thing with this opt-out is it's a one-time. So you must opt out now, or for the rest of your career as a W-2 employee, you will be subject to this tax. So we haven't seen anything in terms of people who are just starting their careers or will start their careers in the next 5 to 10 years. We don't know yet what that looks like. I know that if you're younger and you're pregnant, it's an automatic, the insurers will not qualify you, from what I've heard, same as if you have a pre-existing condition under a certain age. So definitely talk to your insurer, see if you can get on a policy. But I do think there's a lot of red tape in terms of making sure that you can or cannot opt out. Definitely talk to your insurer. As an employer, you have some requirements. You're not required to pay any tax on behalf of your employee, but you must collect it and remit it quarterly to ESD. That's similar to the Paid Family Leave Act. So the first reports would be due, I believe, April 2022. If you are an Oregon employer with Washington-based employees, same as with Idaho, I should put Idaho in here as well because we have some of that, but mostly Oregon. So Oregon employers with Washington-based employees are required to collect and remit payroll tax as well. Washington employers with Oregon-based employees are also required to collect and remit the tax for the portion that is deemed applicable to Washington. You must collect unless the employee provides that approval letter. So that's where I'm worried about the lag time between the ESD being able to process all of these applications and people being able to opt out in time to not remit the tax. They won't refund the tax once it's been collected. And as an employer, you must stop collecting the tax promptly upon receipt of the ESD approval letter. The next fun tax is the Washington capital gains tax, which also begins January 1st, 2022. It is a 7% tax on capital gains in addition to federal. So federal, on a long-term capital gain, you typically pay somewhere between 15 and 23.8% tax. If you are also paying the Washington state tax, you are now paying 30.3%, or no, excuse me. Yeah, 30.3% tax on any long-term capital gains. Long-term means 1 year plus 1 day. Short-term, you are taxed at your ordinary income rate. So that can be anywhere between 0 to 37% at this point. But in Washington, you will not be paying any additional tax on short-term gains. There are some exemptions. Real estate is probably one of the biggest ones. Retirement accounts, family-owned businesses, but there are some stipulations. To be a small business, it has to have less than $10 million in gross receipts for the 12 months preceding the sale. And the taxpayer must hold at least 50% of the business for at least 5 years. Now, there is a standard deduction of $250,000. So if you have long-term capital gains of $150,000, that means you sold it less your basis, whatever you paid for it, is less than $250, or it's $150 in my example. You're not paying any of the Washington state capital gains tax. Now, if you had gains of $300,000, you would pay 7% on $50,000. So just keep that in mind. That's a tax planning opportunity. If you have a bunch of stock in an account or a business, you can do an installment sale. You could also sell 1 year, for example, end of December, and then wait until beginning of January to sell the next $250,000 worth and separate those years. It will create a new tax form if so you would need to file that new form if you owe the tax. We haven't seen a draft of it yet. They're still creating the form. There currently are 2 lawsuits challenging the tax, so it could be overturned because many believe that, well, our Constitution, Washington State Constitution, says that we do not, we won't do state income tax. Now, the argument is whether this capital gains tax is income tax or not. There's different views. The 2 lawsuits are moving through the courts at this time, but for now it stands, it's signed into law, and it will go into effect in a few months. So many are potentially selling tax or selling stock or whatever it is this year before 12/31 in order to not have to worry about this 2022 and forward. The other big tax item is the child tax credit. This is part of the American Rescue Plan that President Biden signed into law in March. It increased the tax credit for many people. It makes the tax credit fully refundable. So for many people, if you didn't have high enough income, you would not receive your $2,000 child tax, $2,000 or $500 tax credit. Now that it is fully refundable, you will get the full benefit of that. And you can receive half of the estimated credit starting in July 2021 up until December 2021. It also increased the age from 16 to 17. The advanced credits began July, and the other half will be claimed on your 2021 tax return. So right now you can receive, this is a little bit farther down the slide, but if you have a child 5 and under, you receive $300 monthly for 6 months. The other half of that credit will come on your 2021 tax return that's due April 18th this year, 2022. We are warning some people that if you're receiving the credit now, you may be surprised when you file your tax return because you've already received half of it, so you only have half of what you may have had in prior years. The credit went up from $2,000 to either $3,000 or $3,600. So it may not be as big of a hit depending on your specific situation. I would contact your accountant or CPA that you work with to discuss that if you have a concern. For children 6 to 17 years old, the credit is $3,000 or $250 monthly. To qualify for the child tax credit, you must have filed a 19 or 2020 tax return and claimed a child tax credit, or they have a non-filer tool on the IRS website. They would need to know your child's social security number, birthday, and your filing status. You also have to have a main home in the US for more than half the year. And you have to have a valid social security number for the child. Phase out. So the $2,000, there's kind of two parts to this child tax credit. There is the $2,000, and then there's the additional $1,600 or additional $1,000, depending on your child's age. That additional kind of kicker, I guess I'm going to call it, phases out pretty quickly. So for single, it's under 75,000, had a household under 112,500, married 150. The $2,000 phases out at the way that it used to. So for many people, that's at 425,000. It's just that additional kicker phases out pretty quickly. And that's kind of what my second paragraph is chatting about. But same as the prior law for the 2,000, additional is the new law. There is a child tax credit portal, so you can update for any new children, any your filing status changed, married or divorced, or you're now head of household. You can also elect out of these advance payments. And if you're married filing joint, both spouses will need to log on and opt out. Otherwise, they will send you, because if you get half monthly, they would send you your half of the half, if that makes sense. There's the website right there to opt out. I will say that some people have trouble verifying their identity with the IRS. It just depends on what loan, like if you have a mortgage, they might try to tie it to a loan, cell phone that they have on file. So it really depends. If you have questions, feel free to talk to your accountant or CPA. I will note that each person's specific situation can be very, very different. So what I'm talking about is it can be very specific. This is just an overall, here's what the rules are, here's what we know, but definitely chat with someone if you have a specific question. And it looks like there's some questions, so I will answer those. So one of the questions is, do you know approximately how much private long-term care insurance costs? I'll tell you my personal situation. I went to opt out for myself and my husband, and for us, we're in our 30s, it was about $25 a month to meet the bare minimum. It will definitely change depending on your age, any pre-existing health conditions, but I think that policies start around there and can go up, of course. The nice thing about having your own private policy is that it's portable. So if we move to another state, we would have this insurance policy. Whereas if you stay on the Washington State plan, you must be in Washington State. I do have Stephanie asked another question. Any ideas what insurance companies currently offer long-term care coverage? Yes, the one that I'm going through is New York Life. So I use them. Other than that, I'm not sure that's who we've been using as a firm, as New York Life. But hopefully your insurer can kind of give you some information about that.